Greetings, trusted clients and friends. I am GK, your trusted financial advisor. And today I just want to take a quick assessment of, unfortunately, a very tragic case, but also how the beauty of life insurance could actually enhance this circumstance. And today our story comes from outside of Jamaica in the United States. If you're on social media this week, you would have seen it. If not, well, here's the story. Two engaged persons, a couple, just bought their first home, a 4-year-old son. Life is going good, then tragedy struck. The wife met in an accident, passed away. The husband getting the call on his way to the accident, he passes away. And so we have this double tragedy, and the circumstances that are left behind are not necessarily favorable. We have an unpaid house, we have a 4-year-old child that needs to live the rest of his life, and also the need for a community. So what also puzzled me about this case is the fact that neither of the two parties was wearing their seatbelt. And a seatbelt in this case could have at least ensured at least one of the parents would be alive here today. Something as simple as a seatbelt could have enhanced this overall tragic experience. And I want to use another life seatbelt, which is life insurance, and show you how life insurance could actually enhance this situation. Now, when I look at the major financial concerns here are: one, the asset retention and protection, then the child's welfare, and also estate distribution. How will the properties be distributed after their death? So let's look at asset retention. Now, the home is perhaps one of the biggest financial burdens currently at the moment. And there are two realities that exist for this home. One, the bank can repossess it. Or two, if there was some form of security, then that security would actually pay off the mortgage. You see, that's how life insurance actually works, and is actually a beauty. One of the first things that you do when it is that you are taking out a mortgage, the financial institution will require the party or both parties to have life insurance equivalent to the amount of the mortgage. So let's assume in this case that the mortgage costs around $400K USD. Both parties, the man and the woman, will be required to have $400,000 in total life insurance. What will happen is that if either party passes away, then the mortgage will be paid off and the surviving party would not need to pay any mortgage. So there would be an immediate 100% equity in the home, and that asset is just there for a lifetime. In this case, however, we have a case where both parties passed away. If the right insurance policies were actually put in force, instead of just $400K being paid out to pay off the mortgage, you will have at least $800,000 available for the child. So let's do some math. If we look at it, the man plus wife minus mortgage, remember we said $800K minus a mortgage of $400,000, that will leave at least a cash amount of $400K. But it actually gets better, because what we're looking at is that, remember, the mortgage isn't just a disappearing debt. It is debt. It is a disappearing liability, which means that the home now has $400K equity, and the total net worth coming to this child is, of course, $800K. So instantly through this tragedy, unfortunately, the child is a millionaire. Without life insurance, we have a double tragedy. We have no parents, nowhere to live, and no income to sustain the child. And that is the first reason why you want to have life insurance in your portfolio. The next aspect that we want to look at is that of the child's welfare. And what does this mean? Well, you see, it is assumed if the parents were alive, the child will be maintained until the child is an adult, correct? So we need to ensure that there is enough money available upon the death of the parents to actually take care of the child throughout his or her life, ensure such things as education, medical expenses are taken care of. Now, we don't really know how or how much money will be required for the child to be sustained. But in life insurance, we have several different formulas that we use to calculate and predict at least a minimum amount of money that will be required in the immediate moment to take care of the child throughout his life. And that is the income factor. How the income factor works is that we figure out the age. In this case, the child is 4, so we assume that the child is going to need income for at least the next 20 years to at least finish college. So we take the years that the child needs to get to his or her sustainability, and then we multiply that by the income of the parent or parents. In this case, we're going to assume that both parents in combined were earning around 150k USD for the year. And so we have 20 years times 150k USD, which will give the child a need of 3 million USD. I know it sounds like a lot in the present, but spread over 20 years, it's not that much. Now, how would they go about getting this amount of money? Well, you can split the life insurance down the middle between both parents. Each parent having at least $1.5 million saying, you know what? If we are taken out of the picture, the child can be sustained throughout his or her life, right? And that money, of course, you see, when we calculate the 3 million, we are not factoring inflation and such. And that's where your other investment instruments come into place, such as setting up a trust fund, using mutual funds, perhaps based upon how the will is structured, the declaration to buy some stocks, etc. It varies. But what is guaranteed is that monies will be available for medical expenses, college expenses, and of course, the day-to-day living. Now, we look at the final part of our presentation, which is the estate distribution. How will the properties be distributed? Now, what is an estate? Now, estate is all the money and property owned by a particular person, especially upon death, right? And so that is one aspect. It's not just the house; it's everything that you own, jewelry, etc. Now, an estate becomes powerful by having a will. As they say, where there's a will, there is a way for your properties to actually be distributed according to your wishes. Now, there are two possible outcomes in this situation: no will or having a proper will in place. Without a will, you have a problem of your wishes not being maintained, as in like people are going to fight over the property, or the government is going to decide who gets it. And the last thing we want to do is that uncle or auntie from out of nowhere that we never liked in the first place to want to have a claim in our property, or even worse, we have the government decide who gets what. We have seen how the government handles their own money, and we know that won't cut it, right? So the question is, who do you want to handle their affairs? And so the best thing that you can do is to have a will in place. Now, to be honest, a will is a very big and technical issue, and the best thing that you can do when you have a will is to get your attorney. But there are some possible outcomes, because you see, the will has to be structured in such a way where the child benefits. If the child is on both parents' will, then of course the properties will go to the child. But let's say that the man was on the wife's will. Because she died first, all her properties will go to him. But because he also dies, all his properties will go to the will. And if the child is not on his will, then of course it now goes to the government again to decide. And so in setting up your estate planning, you want to ensure that the properties are properly distributed and things work the way they are supposed to work, right? And as I said, when it comes down to the estate planning, get a lawyer. But let's look now at the financial aspects of estate planning. You see, estate planning is not just, if my dead, the son get a house. No. There are taxes as a part of that, expenses, legal fees. It is a very expensive process. Let's just imagine that you have an estate of 1 million USD. What if that will actually, the cost for that is around 200k or so USD, just for example, right? So depending upon the asset, you want to ensure that money is there. Part of estate preservation is to ensure that liquid cash is available. And life insurance is one of those miracles. Because even if you leave money in your bank account or in an investment policy or anything like that, and it is not, there's not an immediate beneficiary to it, all of that money goes into the estate. And anything that goes into the estate must be probated by the court of law. And that, if you have a will, may take about a year or so. If you don't have a will, that can take 5 to 10 years. By that time, the child don't pauperize and go turn gunman and all these things. So one of the key things you want to do is to ensure that you have enough liquidity as it relates to your estate. The moment you begin to accumulate wealth, the first thing that you want to do is to get your insurance and get your will in place. Death is the last event that we will experience in this life. And because it is the last event, one of the key things we do is to deal with the last things first. We're sure that it is coming, we just don't know when. And so you want to get the necessary things in place first. One of the first things that you want to do as you begin to accumulate wealth is to have sufficient life insurance in your portfolio. For many reasons, but we're not going to go into that. So here's the thing. If you need a trusted, well, you will definitely need a trusted financial advisor, because you don't just want to be buying a life insurance policy. You want to ensure that the necessary calculations are done and the right kind of policy is actually recommended to offset your financial portfolio. I am GK Trusted, financial advisor, investments, insurance, financial planning, etc. If you need insurance, you better call GK.